Bank of Canada just held their rates steady for another month in July of 2025, and you might be wondering what's coming next. Well, they also dropped their latest monetary policy report, and if you do like digging into data, these interactive charts on here are actually pretty solid. But I am going to be walking you through the key takeaways from their Outlook section. So let's dive in. Here is the main takeaway. Inflation is expected to hover around the 2% target through 2027. Now, some things are pushing prices up, like the new possible tariffs and the end of the temporary carbon tax break. But at the same time, slower demand, a stronger Canadian dollar, and easing housing prices are helping to pull inflation back down. On our economy side, the economy has actually been more resilient than many people expected, but we are likely going to shrink a bit for the second quarter of 2025, and the exact data will come out at the end of August. So basically, growth is expected to remain slow. The latest outlook for 2025 and 2026 are actually worse than what was predicted back in January of this year. Job losses are rising, trade tensions are weighing on growth, and the Canadian dollar is also strengthening against the US dollar, which isn't great for our Canadian exports, especially when global demand is uncertain. There are 3 more Bank of Canada rate announcements left this year, and right now, more than half of Canada's big 5 banks and major economists are predicting more rate cuts later for 2025. The Bank of Canada might seem like they're guessing, but they're also watching these things like core inflation, GDP growth, unemployment, global trade issues, and how businesses and consumers are spending. But the biggest driver will be inflation. If core inflation drops below 2% and stays there, that will be the clearest signal that we will see more rate cuts. So, what does this all mean for real estate? Well, even if rates do come down a bit, don't expect a huge bounce back in home prices. September typically brings more listings, but buyer demand usually doesn't rise at the same pace. And what this does is it usually creates a downward pressure on prices, especially for sale listings. So unless we do see a sudden rush of buyers, which isn't looking likely, prices could soften even more. Now, to be clear, we're not expecting a crash for the rest of this year. Since 2022, Toronto home prices have been moving in range, some up, some downs, but nothing dramatic either way. We might see prices dip towards the bottom of this range for the rest of 2025, with a possible bounce back in early 2026. And what this does is it does give a steady market for investors with real opportunity. You can buy during these softer periods, lock in lower prices, lock in stronger cash flow, and benefit from stable or even falling interest rates. At the end of the day, land value in Toronto does go up over the long run. And with solid fundamentals in freehold, houses, in Toronto, limited supply, strong demand, and a growing rental market, you're setting yourself up to win long term, both from rental income and appreciation. Right now, there are real deals out there. For example, you can pick up a single family semi-detached house in Midtown Toronto for $900,000. You'd have to put in $150,000 of renovations to convert it into multiple units, but then afterwards it would cash flow over $2,000 a month with 3 units. Some of these properties might even have room for a garden suite in the backyard, and if you build this, you can boost your income even more. These deals are not impossible to find, and yes, Toronto properties can cash flow despite what you might have heard. You just need to know where to look, and that is exactly where we come in. We're a Toronto real estate sales brokerage that focuses on multiplexes, and when you work with us, we help you spot the right deals, crunch the numbers, buy smart, coach you through renovations, lock and solid tenants, and even offer property management. If you are ready to get started, just head over to this link here and let's get the ball rolling.